This is the kickoff, Module 2.6 through 2.12 is the financial meat of the matter. In other words, the next 6 modules we're going to try to become, kind of basically ABCs of financial management fluency, because all employees are going to have to be sort of co-managers of the bottom line. Turns out we cannot achieve high-performance distribution service economics if everybody isn't caring, sharing, looking at those numbers. So open book management is a cute term, and it is a key piece of high-performance distribution economics, but it's hardly sufficient. I mean, there's a lot more that goes with it. So we've got to now start replacing sort of rumors and wild imaginations with the hard realities. If you do surveys of employees that work at companies that where generally they've not shared all the general financial numbers with all the employees, you get some wild results. Let's look at some of them. I told you earlier in Module 2.1 about Sears Roebuck, where in 1993, they asked all the sales associates what they thought was going to the bottom line, the profit line, and the average answer is 45%, when in fact it was 1.7% before taxes were paid. So that number would get about halved by taxes. And what's interesting is that Sears is a publicly traded company, so in theory people could have gone and looked at the financial reports and tried to figure out what the retail sales store unit was doing. Other surveys will find that people who work for manufacturing companies typically think the manufacturers make about 40% of the total annual revenue or sales dollar in profits. However, when they survey retail and wholesale employees, the perception is that it seems to be a thinner margin, more competitive kind of business, and that those kind of companies only make 20%. But in fact, when you look at the actual numbers for retail and wholesale, after taxes, it'll be about 0.5% for those businesses that have high volume, high turnover, and thinner margins, up to maybe 2% profit after tax of percent of sales for those companies that have slower inventory turns, 3 a year, for example. And then most of, if not all of that profit has to be reinvested back in the business for growth capital. We'll come back to that concept in a bit. There are other sources for profit numbers. The one I've chosen, and there are about 35 different trade associations, for example, in the wholesale distribution world that actually have members gather all their numbers and send them in. The one that I've chosen is the IDA, the Industrial Distributors Association, based out of Atlanta, Georgia, serves an industry of what are called industrial supply or mill supply companies. They sell all the grinding wheels and tools and safety supplies, general sort of supplies that would go into manufacturing America kind of plants. And there might be about 10,000 of these creatures, distributors across the country. Maybe 1,000 plus would belong to IDA. And in turn, about 187 of those members chose to send in their 1999 tax data. So somewhere around 2000, the March of 2000, they said, all right, here are numbers we sent in to the IRS for 1999. And they sent them to a company in Boulder, Colorado, who run by a fellow named Al Bates, profit planning group that crunches all these numbers together and comes up with the ratios and all sorts of ways of comparing companies and so forth. And so that's the group I'm going to look at. Now I asked Profit Planning Group if they would take the 187 members from IDA that sent their numbers in, instead of saying here's what the bottom 75% of the performers did versus the top 25%, they could make the split more dramatic by taking the bottom 90% as a group and find what their average numbers were and look at the top 10%, because the top 10% are so much better than everybody else, it's sort of shocking. And so I think it has good value to do that. And if we look at the numbers, here's what we found out. The average guy out there, in other words, in the bottom 90% of all the distributors, did $8 million and change, $8,102,704 worth of sales. So that's 100% of their sales figure. Turns out that the bills they paid to their suppliers for the cost of goods worked out to be about 75.2% of sales. If you subtract the difference, you come up with gross margin, or the wholesale distributor's value added. So their value added percent was 24.8%. Out of the gross margin, that's what the distributor pays all their expenses. And you can see that payroll expenses ran 16% of the sales dollar, or if you said what percent of it was of a smaller number, 24.8%, it was 64% of the margin dollars were turned around and used just to meet payroll. And you can see that occupancy for the warehouse is really pretty low. That's why they're thin metal buildings out there in, parts of town where the cost per square foot is very low. And all their expenses were not that great. So in other words, personnel expense was by far and away the biggest deal. Well, when you subtracted all the expenses, the average industrial supply distributor in the bottom 90% took to the profit before interest and tax line 1.6%, or $129,000. So you think, well, wait a minute, $8 million in sales, we're not taking a lot of money here to the bottom line. And that isn't the bottom line. It turns out that if the company borrowed money from the bank, the interest they paid on that loan can be deducted. So maybe they had $20,000 in interest. And then whatever's left, they have to pay taxes. Now, just like personal income tax, corporate taxes are graduated. But they pretty quickly get to the point where on the marginal dollar, one more dollar of profit you make, you're paying about 50% in taxes to the city, the state, because you have to pay 3 levels of taxes, and the federal government. So maybe if this company was debt-free and didn't have any interest, they might have paid an average tax rate of 30% and had $100,000 profit after tax. Now, there are different ways to look at these numbers. If the company is doing 8.1 million in sales, first of all, what does that contrast, and they're making $130,000 in profit before interest and taxes, how does that contrast to traditional roomers? I find in companies that do not share any of the numbers with employees, only on a needs-to-know basis, the frontliners, after a while, maybe a year and a half later, hear a figure, $8.1 million, but the rumor is that's what the shareholders took out of the business. In other words, they confuse sales for the company with profit after tax, and 100% of it is dividended. It's excess profits that can go out of the business, opposed to maybe some of it's reinvested back in the business because all that inventory and receivables not financed for free. A second way, and those companies that share all the sales figures but point out it's just sales, people are thinking 20%. So that would be about $2 million went to the bottom line and 100% out to the shareholders. So the rumors are way off the mark as far as what's really going on. Another way of looking at this is if you took 100 pennies and you said, all right, we have 100 pennies and that represents our sales. Let's take away 75 of the pennies. That gives us our margin dollars. Let's now take away over half of those pennies, 65% of those pennies. So boom, there goes another 15 pennies. Now we're down to 10 pennies. And we use that to pay, because the 15 we took away are for payroll expenses. And then we take away pennies for, 2 pennies for occupancy, 5 for all our things, and you get down to 1 or 2 pennies. It kind of visually gives you an idea that, this company isn't making much money at all. This is pretty a small, fragile number. Another way of putting that profit number in perspective is to look at damage. If somebody accidentally runs a fork through a prong through a box and the stuff is damaged or bent or whatever, what does it cost the company to make that up? A lot of people would say, well, if we bought it for $1 and we have to write off $1 of wasted goods, we know that when we sell stuff, we make a 25% margin. So maybe we have to sell $4 worth of goods to make $1 of margin, gross margin, to pay for the waste. That's not the way it works. If you sell $4 of goods, you have $4 worth of related expenses that go with it. Phone calls are happening, people are working, payroll has to be met, you have to pick it, pack it, pay freight, all those things. So the better number is to go back and say, well, if we're making on $1 sales 1.7% at the profit line, 1.7 goes into $1 how many times? And you realize, my gosh, it goes in there over 50, 60 times. So we have to go get $50 of sales to pay for $1 of wasted goods. And so you start to realize, whoa, our bottom line is so small, waste really hurts us. Now, let's go look at the top 10% of the best performers in the IDA performance group. On the left-hand side, you can see annual sales for the top 10% averaged 11.3 million and change. So, that's up from about, $3 million more than the average, the bottom 90. What's interesting is look at the cost of goods. Instead of 75%, it's only 67, or if you subtract and find out what the margin percent is, the top guys have a margin percent of 32% versus the bottom 90 at 24. The difference, is 29%. In other words, 32% is 29% more of 24.8. If you look at payroll expense, you can see that the top performers are spending more as a percent of sales on their people, so pay more, get more, it looks like. But because they have such a huge margin percent, when you get to the PBIT line, profit before interest and tax, instead of doing 1.7, 1.8%, like the bottom 90 are in the right-hand column, they're doing 7.3, which is 4 times the profitability. Also, if you look at that number we talked about in earlier modules of value added per warm body, the top performers are doing $81,000 in margin per warm body, whereas the average guys are